Welcome to today's webinar. I'm Dr. Guy Schofield, the course director for the Master of Applied Finance at Macquarie Business School. I'd like to start by acknowledging the traditional custodians of the land on which we are gathered and pay my respects to their elders past and present. I would like to extend that respect to all Aboriginal and Torres Strait Islander people here today. I'd like to introduce our speakers, Professor Elizabeth Sheedy, Director of the Governance, Risk and Compliance Institute at Macquarie Business School, and Vincent McGrath, the PhD student at Macquarie Business School, both who are instrumental in the research that we're going to hear about today. And also a warm welcome to Ross Piper, Chief Executive at Superannuation Australian Ethical. So to start, as a backdrop, ESG, or environmental, social and governance investing, is one of the most important investment trends of this century, and we're very kindly reminded of this by a recent ASIC announcement that came out this week on greenwashing, which hopefully our panelists will talk a bit about. But controversies abound, and it has become part of the culture wars in some places. So concerns, as I mentioned, about greenwashing and whitewashing are widespread. And in this context, the recent research by Macquarie has looked under the hood of ESG investing to better understand how it's practiced today. Now, the format for today's webinar is to invite Elizabeth Sheedy and Vincent to take us through their research findings. We will then ask for Ross to provide some reflections and responses. And then I'll bring everybody, Elizabeth, Vincent, and Ross together to answer questions. Now, you'll see on the webinar, you'll see that there's a button there. So if you wish to place any questions, please feel free as we go to simply add any questions to the Q&A. And what we'll do when we get to the end of the session, we'll try and go through all of the questions. And those that we don't get through, we will endeavour to provide a response to later on. So thank you to everybody for attending. And if I can invite Elizabeth to take us through the research findings. Elizabeth.
Thank you, Guy. It's really great to be with you today. It's always a pleasure to share research findings with people working in the industry and our alumni. The research today that I'm presenting is joint research with my PhD student, Vincent McGrath. So really, Vincent is the one that did most of the hard work. I just looked on and gave a few pointers from time to time. But what we discovered in the course of this project was extremely interesting to us, and I hope that you will find it both interesting and relevant to your lives and to the work that you do. Next. So this presentation is really getting under the hood. The slide there, Guy. The aim of it was to have in-depth conversations with a small number of participants in the industry. So there had been some surveys conducted of ESG investors. What we wanted to do was to have a series of interviews with people in senior roles working for super funds, and asset managers, and in some cases, some investment advisors. So we wanted to talk to them about the day-to-day practice of ESG investing. And it's when you're in these interviews that you can really toss ideas around, ask follow-up questions, and you can get a lot of insights from that. So we did 26 interviews. They were conducted in 2021 and 2022. So just showing you there the distribution of participants in terms of their tenure in the industry. And you'll notice that the majority of people who participated in this study were quite experienced. So, they had more than 10 years experience in the industry. so some of them were in quite senior roles in portfolio management and stock selection, and in some cases they were ESG specialists with the special brief to focus on ESG. As well as the interviews, there was a short pre-interview survey that each participant collected. Next. So one of the first issues we wanted to explore was the question of why these investors are incorporating information about the environment, social and governance issues into their investment process. Now notice, so the red bars are showing you the results from our study, and we're comparing with the grey bars. Now this is a study that was done a few years ago and published in the Financial Analyst Journal. Now, they're not directly comparable. Obviously, there's a few different here. One is that time has marched on, so our study was conducted 5 years later. The other thing is that the study published in the Financial Analyst Journal was an international study. They had more than 650 responses, of which 40% were European and about a third from North America and the rest from Asia and other parts of the world. So there's a number of differences. So, we thought we need to be careful about drawing comparisons. So please, as you compare the two studies, please have those caveats in mind. But I think that the really noticeable thing is that in our sample, we're looking at almost 90% of people that believe that it's ESG information is material to investment performance. And that is the most quoted reason for using ESG information. And that's certainly significantly higher than what showed up in the earlier international study. But there are other factors. It's not just about investment performance. It's also about the demand that is coming from clients and other stakeholders, and a desire to bring about change in the companies that they are investing in. And that's something that we'll be returning to later. Thanks, Guy. We also, what about not incorporating ESG information? Well, in fact, there was only one participant in our study who did not incorporate ESG information. So it's, as you can see, that's very much less than what came out in the previous study. In that earlier study, there were a significant number of participants that did not incorporate ESG information for various reasons. So things in our sample, we had a group of people that were committed users, generally speaking, of ESG information. Thanks, Guy. So I think one of the things I want to do today is share some direct quotes. I want to let our interview participants speak for themselves. So this quote is a good one because it really fleshes out this idea, this belief that ESG investing is material for investment performance. So this asset manager said, we're not doing ESG because it feels good and it's nice to have, which obviously helps, but we're doing it because it does add value. The research we've done and the back testing we've done shows that if you invest in a group of companies which have an overall good ESG score, at the portfolio level, it does add value. And so that was the kind of sentiment that we picked up. Thanks, Guy. Here's another similar quote from an asset owner this time, I think probably a superannuation fund. I believe quite passionately that ESG, or responsible investing, can make a real difference to long-term shareholder risk-adjusted returns. This stuff works. So I think that the word passionately there is important. It did a number of participants in the study felt quite passionately about what they were doing. Thanks, Guy. So just to tease out a little bit more, how does ESG information add value to investment performance? I think what this graphic shows us is that the most important response was for managing portfolio risk. So we did have some people saying that ESG information is a source of alpha. In other words, that they see it as boosting up their returns. But that was not the most common view. So most people saw ESG information as helping to manage risk. And so, in other words, to get better risk-adjusted returns over time. Thanks, Guy. We spoke to the participants about the relative importance of ESG information versus traditional financial information, the sorts of things that you would find in the accounts. And what was interesting here is that more than 70% of our participants felt that ESG information is as important or more important than traditional financial information, which is quite striking. We then asked them to break it down for us into those various categories, so the E, the S, and the G. And we also asked specifically about culture, because culture is arguably culture could fit in under governance, but it was a little unclear. So we thought it'd be good to ask that question separately. So what you can see is that, in fact, it's the G that people put the most importance on, and culture is right up there. So culture and governance was the information that was most valued by participants in our study. Environmental next, and at the bottom of the pile, relatively speaking, social. Although still more than 60% of participants place a very high value on social information. Next. Another question that we wanted to explore with our participants was how they actually incorporate this ESG information into their investment process. So we gave them a range of possibilities to think about. I'll just focus on the answers that were the most popular. So the big one is engagement and active ownership. So in other words, they use this ESG information to work behind the scenes with directors and senior executives to actually influence the policies and behaviour of the companies that they invest in. This is, I think, probably for me, the biggest learning from the whole study, that really Australia is emerging as a utopia for active ownership. And we'll talk shortly about some of the reasons for that. This really interested me. Negative screening, for those who are not familiar with that term, that's the idea that you might exclude a company from your investment portfolio because you feel you don't like their some aspect of the company. You don't think it's good value, or you don't like its ESG status. Yes, there is negative screening happening, as there is positive screening, but active ownership was by far the most popular answer given. Next. So here are some quotes to flesh this out a bit. Okay, so we asked people to talk about their engagement experience. So this asset manager was commenting about how things have changed over the last few years. Yeah, it's interesting. Engagement is evolving quite a lot. When I started at my firm a bit over 3 years ago, there weren't many companies that were willing to engage on ESG matters. And I think they all saw ESG as a bit of a nuisance. So the engagement from companies has really ramped up, which has been good. Next. I think another point to make is that the interviewees that we spoke to, they were able to give very specific examples of cases where they had engaged with company management and there were actual changes in policy that they could point to that came as a result of that engagement. Okay. So here's another quote from a different asset owner talking about why they think engagement has become more important. Okay, and this person attributed it to the advent of the 2 strikes rule for remuneration. I think that has really lifted the engagement for the companies. It used to be us asking for meetings. Now the companies regularly come to us wanting a meeting. So if you're not familiar with the 2 strikes rule, this is the idea that shareholders get to vote on the company's remuneration policy and outcomes at the annual general meeting. And if in 2 consecutive years there's a vote against, then it's possible to call for the board to be replaced. So that new development in governance has actually given shareholders much more say in company policy, not just remuneration strategy. Next, thanks. Another investment advisor commented about the engagement. Yes, access to engagement is good and much better than the United States. It is totally different about how open the companies are to engagement. So it's quite fascinating to draw the contrast between Australia and the US. So I think the US is a very different environment, politically speaking. The US is very much a country divided over the culture wars. And I think that those political divisions probably contribute to many companies, not all, but some companies being unwilling to engage with investors on ESG issues. I think also we can think about certain characteristics of the Australian environment. This is a small market, and we have it's a small number in the sense that there is a few very large institutional investors, and I'm referring specifically to the major industry super funds, and these funds do enjoy a lot of influence because they are significant shareholders in so many companies. Next, thanks. So a lot of these institutional investors, such as the industry super funds, have a long-term focus. They are helping their members prepare for retirement. Because they have that long-term focus, they have a much more natural interest in ESG. And the other thing about them is that they understand the importance of banding together. Okay? So the Australian Council of Superannuation Investors, or ACSI, represents a lot of those institutional investors. And ACSI has come to be an important part of the Australian investment scene. ACSI is a fantastic partner. ACSI, they engage really well. They're very good at updating us on what's going on in the industry. They're a great advocate for bringing about positive change, and similarly Hermes globally. That's the major channels that we use for engagement at this point in time. Next. Another characteristic of the Australian market is the regulation, which is commonly known as Your Future, Your Super. So what's happening is that superannuation funds are being assessed and benchmarked against market indexes. And the effect of that benchmarking process is that it makes it quite difficult to deviate significantly from the benchmark. Okay? So for a major super fund to, for example, disinvest entirely from fossil fuels would be very difficult to do, okay? Because there's a risk that certainly in the short term they would underperform the benchmark. So it makes sense to me in this context, given these regulations, that superannuation funds choose to stay invested in companies like Woodside, for example, Santos, AGL, and they try to change those companies. Okay? So they figure that they can do more to improve the climate by staying on as an investor and advocating for changes in the way those companies are run. Next. Now, so what we observed was very enthusiastic use of ESG information, but it's important to recognise that there were a number of concerns. So some of those concerns, if we look at the most popular ones, we can see the fourth one, lack of reliability and assurance. So unlike financial information, ESG information is often not audited. And so we don't know if the companies are engaging in greenwashing. Okay? So are they presenting information that is not entirely truthful? And this is associated with lack of reporting standards, and you'll see their concerns about comparability, both over time and across firms. So clearly the investors that we spoke to had pretty significant concerns about these issues. And you can see that the concerns have grown significantly since 2016, when the earlier FAJ study was done. Next. This one is just talking about some of the sources of ESG information. One of the things that fascinated me here was down the bottom, one of the most popular answers was own analysis. So these days, a lot of institutional investors are doing their own analysis to determine whether the companies they invest in are doing a good job with ESG. Next, thanks. So how we spoke to the investors at some length about how do they distinguish between companies that are really committed to ESG, or alternatively companies that are just trying to give that impression, trying to manage impressions. So this investor advisor had these comments. One other thing I think that you can leverage is peer practice, basically, where if one company is sort of, oh yeah, we're doing stuff on climate change, and then you go to the next company and they're saying, yeah, we've set a net zero target, we've committed to the Science-Based Target Initiative, we have KPMG assured emissions data and things like that. That obviously builds a lot of credibility. So in other words, the investors are looking for concrete steps, not just vague talk, but firm, concrete steps, and ideally some assurance to back that up from an independent party. Next. Another very important tool in how greenwashing is managed brings us back to this idea of engagement. So it's when the investors get to meet with their investee companies that they have an opportunity to really question and challenge their commitment. How we get underneath the detail of what's reported is engagement. So when we meet with management and we talk through their plans, we start to get colour. So they might put out in their reporting a headline metric and say, well, we will decarbonise by this date. but they don't actually tell you what the interim targets are. So we ask, what will you do by 2030? What will you do by 2040? What is that trajectory like? So those kind of conversations happen through engagement. And to be fair, that's probably the cleanest way we can put some meat onto the bones. Next. I was also very surprised the extent to which many of the big asset owners are actually employing their own scientists and engineers. Okay? Well, it's very useful having in-house science and engineering skills. Just to use an oil and gas company as an example, they've been quite vocal with their green initiatives. But when you unpack what they're actually doing, it's totally not based in reality, and it's all marketing. Our engineers were able to unpack that, look at the oil and gas company, look at their activities, look at where they're saying they're going to do carbon capture storage and where they're actually producing their carbon. And there's a total disconnect there. They're not going to achieve what they're planning to achieve. Next, thank you. So I was very impressed with a lot of the efforts that were being made to verify environmental commitments. When it came to the issue of assessing culture, to be honest, I was much less convinced. Now, I have to admit, I am a scholar that has, that focuses on the topic of company culture. So this one was an area that I honed in on particularly. And remember from an earlier slide, I mentioned that in fact, in our sample, culture was considered to be one of the most important ESG criteria. This asset manager says, yeah, definitely. It's a hard question to answer, evaluating corporate culture, because there's not any firm metrics you can look at. It's much more the feel you get. It's something our ESG team tries to incorporate in their ESG scores. But to be honest, the way we look at it is just meeting with companies a lot over a number of years, just getting a feel for how the place works. To be honest, that left me a little bit underwhelmed. It seemed because as a scholar, I know that there are metrics that external investors can use. For example, there's been a lot of research recently looking at the use of employee websites to gather information about corporate culture from the outside. So anyway, that's perhaps something we could talk more about in Q&A if people are interested. Next. So reflecting on all of this, so we saw in the research an incredible, really impressive focus on ESG, particularly on the G. So people considered governance terribly important and that they were engaging with companies on that topic. Yet, as you know, we have observed some terrible governance catastrophes in the last couple of years. The big casino companies spring to mind. Next, thank you, Guy. And then, of course, there's been some recent cyber breaches. So I am sure if you think about what happened with Medibank, a hack of that kind and the damage that was done to their customers, that to me is very solid evidence of a very flawed governance process. Next. Not only are we seeing a couple of these very high profile hacks, but there is also evidence, I don't know how many of you saw this newspaper article only fairly recently, that many firms are not even disclosing hacks that they ought to be. Under continuous disclosure obligations, firms should be disclosing anything to the market that is material to market value. And very often, this is not occurring. So this too would be solid evidence that governance is not entirely well. Next. So I guess this raises a really interesting question. How can we understand all of these problems in the light of the ESG focus. I guess there's a few possible explanations. One would be that the ESG investors, when they go about doing their engagement, they have limited bandwidth. They only have limited time with the companies. And so maybe they are focusing on particular issues, and other things like, for example, cyber risk have been neglected. Let me give you the example. In our research, we discovered that one of the really hot issues of engagement over the last couple of years has been modern slavery. So investors have been quizzing companies about their practices in regard to modern slavery, which is, a worthwhile endeavour. My question would be, why modern slavery specifically? I mean, it's now, modern slavery is unlawful, but that's just one piece of legislation. Companies are affected by numerous pieces of legislation. Why pick on just one? And would it not make more sense to have a broader focus on compliance generally? So rather than going to speak to companies just about one issue, why not ask the company about their risk and compliance frameworks and their risk and compliance cultures? I would have, but perhaps that would be taking a broader focus would be more effective than just focusing on one or two hot issues of the day. I think I do have a concern that some of the governance focus that we observed is a little bit misdirected, and that perhaps ESG investors could do even better at bringing about positive change in companies by perhaps changing the way they do things. But I've probably said more than enough, and I'm sure everyone's very interested in hearing what Ross has to say, and I will quickly stop.
Thanks, Elizabeth. So that was fascinating, and I'm sure we've got a number of Q&A questions. So thanks everybody for the Q&As. Do keep them coming. As we carry on now, let me introduce Ross. Ross has very kindly agreed to give his reflections on the research. So without further ado, let me hand straight over to you, Ross.
Great, thank you so much, Guy, and thank you to Elizabeth and Vincent for the research, which is very rich, and a number of, I think, really relevant points and themes that emerge from that. So I speak to you today. My day job, I'm the Chief Executive of Superannuation of Australian Ethical, which is a fund, an asset owner and an asset manager. But I'm also the chair of the board of the Responsible Investment Association of Australasia, or RIA. RIA has over 500 members, and in fact, within that cohort, representing almost $29 trillion of funds under management globally, or north of approximately 1.3 trillion here in Australia. So it's a really fascinating space right now. And a couple of very brief remarks. Firstly, to simply note that responsible investment, or ESG, is continuing to evolve and experience extraordinary growth, and in many ways is increasingly embedded in mainstream investment practice. And it's really almost if you want to be operating in the market as an asset owner or an asset manager in some way, shape or form, you are seeking to understand and embrace ESG as part of your broader approach. A couple of things I think that are driving that. Fascinatingly, there's a strong consumer demand dimension, and the research that you've just heard, and obviously the research that RIA and other groups do, just highlight how many Australians are increasingly wanting to see their money invested ethically, responsibly, and of course ESG is a part of that. But you've also got the intersection of increased regulation in this space. Guy mentioned earlier the recent actions by ASIC around greenwashing. I think we're going to see more of that, and more than happy to speak to those things. But I think if you also recognise that there are increasingly material social and environmental issues that have an impact as an investor. So thinking about particular sectors, we work in the game of trying to maximise risk-adjusted returns for the members of our funds or investors. But increasingly, to ignore things such as climate risk, social risk, governance risk, from a pure investment thesis is clearly a gap. And consequently, as you've seen in the research that's just been shared, it's an area of very strong increased focus. But the other thing that I'd just like to highlight is that with the growth of responsible investment commitments and products, the focus of responsible investing is actually expanding beyond managing risk and avoiding harm, or ESG, as we've talked about, negative screening, and is increasingly now looking at quality stewardship or contributing measurably to positive real-world outcomes. And things such as corporate engagement or impact investing actually speak to that. So we're at this really interesting point in our market right now where you have almost a bottom-up set of drivers, consumers increasingly voting with their feet and expressing expectations about where and how their money is invested. There's a top-down dimension here. So from a governance risk standpoint, you might recall in the last 18 months, there's been a couple of fairly high-profile cases where superannuation fund members have actually tried to sue the trustee or their fund for failing to take into account climate risks within their portfolio. But of course, the third pillar then is an increased regulatory focus. And both APRA and ASIC are increasingly holding asset owners, asset managers to account around the extent to which they're considering climate risk within their portfolios, or indeed the greenwashing examples that we've spoken about recently. So we're at a really interesting point in our market as we see continued maturation, continued consumer growth, and in many ways, we see progressive or enlightened asset owners and asset managers moving beyond ESG to now actual active strategies that look at stewardship and actually delivering good through the investments that are taking place. The final remark that I'll make before we have questions, and I'm sure there'll be a number of good questions, is that we've seen a very significant change in the political environment over the last 12 months, certainly the change of government and the current debate that is raging about the definition of superannuation and to what extent super plays a role in the longevity and retirement benefits for Australians versus investments of superannuation funds in nation-building projects. For me, I think the super wars are in some ways fatiguing because ultimately superannuation funds are investors and we have a very, very clear focus on investing for the best financial outcomes that our members can be achieved. But in order to deliver that, I don't think investors can ignore the factors that influence risk around particular sectors or trends that are occurring environmentally, socially, or from a governance standpoint. So again, this is no longer a nice to do something on the side, it's actually part of core business. And I don't think there'd be an asset owner or an asset manager, certainly in Australia, New Zealand, or even abroad, that isn't in some way, shape or form grappling to try and understand this. I'll pause there. Look, very happy to take questions or comments and I look forward to a rich conversation. And again, really appreciate the research and the report that's been shared today.
Thank you very much indeed, Ross. Some really interesting points there. So if I can invite Elizabeth and Vincent to join us in the virtual room, as it were. We've got a number of questions that have come through. So let me start by going through one of the first questions, which I thought was really interesting, which is, and I'm not sure whether both Ross and Elizabeth both want to comment on this because it's quite an interesting comment here. The question is, in terms of active ownership, how has this translated to how asset owners have voted as shareholders, particularly on issues such as carbon transition?
Look, I'll make a couple of brief remarks, and Elizabeth, please feel free to add to this. As the research has rightly highlighted, active ownership has typically formed a fairly core part of the strategy of many asset owners and asset managers. And I think there are a number of examples where companies have been very actively engaged in influencing materially corporate outcomes. I might point to the example of Rio Tinto and the Juukan Gorge incident that occurred and the pressure that was brought to bear on Rio Tinto by a number of the superannuation funds, but also the investment community more broadly, that actually resulted in very, very significant changes at a governance level for that company. And as someone who actually worked with Rio Tinto many years ago, I think that in and of itself is a fascinating case study a company, and I guess the reputational and financial cost of getting some of these things wrong. So I think active ownership has proven to be effective, but it is work in progress. And the other remark that I'd make briefly is that there's a very live discussion and debate about to what extent an organisation or an asset owner or an asset manager can influence change. And in some cases, divestment or negative screening might be the right answer. In other cases, it might be a case of, look, we think we can influence change far more effectively as an actual owner in that space. And so there's a core question there around what are the investment beliefs that your entity actually has? And again, seeking to be true to label to those things, because I think ethical or ESG or responsible investing is not necessarily the same as deep green. And those two issues can sometimes be unhelpfully conflated in the marketplace. Elizabeth, you may want to add to that.
Yeah. Actually, Vincent, did you want to speak at all about the conversations you had with people about voting specifically?
Well, one thing I think that came out of our research was the amount of behind-the-scenes conversations that take place prior to the voting, and certainly one of the topics that's most important is decarbonation plans, and so it's a lot of behind-the-scenes prior to voting. I think is a way that asset owners influence.
Great, thank you for those comments. So I've got another question here. If we would like to take it, why is there still a lack of standardized criteria to point to whether an investment is sustainable? Wouldn't having the objectivity of that kind make it worthwhile for entities to invest in ESG?
Perhaps I'll make a few brief comments. Firstly, to say that there's an enormous amount of work being done around standards, both here in Australia, but also in Europe and other parts of the world. In fact, the work in Europe is probably far further progressed than it is here in Australia. But folks on this webinar may be aware of a group called ASFI, the Australian Sustainable Financial Institute, which is the outworking of a whole body of work and thinking that has been put in place to try and introduce a standard taxonomy around labelling and so forth. And so this whole issue of standardisation, being able to measure these areas, is getting a huge amount of focus. RIA, the group that I chair, has been heavily involved in defining and setting and articulating standards for responsible investing and seeking to define leading practice investment for more than 20 years now. And RIA has a standard in the marketplace that is very commonly used and applied around, so that market certification is something that is increasingly being sought after, because otherwise you end up in a space where greenwashing or impact washing is rife, and regulators have rightly engaged and understood the risks around some areas of that. It's not a perfect science and never will be, because in some ways you are trying to measure a number of both objective and subjective or qualitative factors. And as Elizabeth has unpacked so well in the research, social, environmental governance has many, many dimensions to those things. So it's a body of work that is gaining significant momentum. But I do think in Australia we will see a taxonomy come to life very soon, particularly with the strong support of the current government that we see in place. But work in progress, and it's an important area to get right.
Yeah, I don't have anything to add there. Good, great answer, Ross.
So I've got another question which sort of builds on this. I think, and it was an area that I kind of was interested in myself, which is broadly the question of what educational needs do we need in this area. So we've got a question here to do with ECF, which is the Enhanced Competence Framework. And there's a standard set of skills apparently for bankers to take classes, and it's conducted by the Big Four consultancies. I guess the question here is, to what extent do we see that as being an important factor in this journey? Ross, perhaps you can start off on that one.
Yeah, I simply say that I think this is a competency that is just becoming so core to the investment, to the financial services industry. Whereas in the past, even 5-10 years ago, it may have been something where asset owners, asset managers may have had a very small research function or an ESG function. I think anyone moving into this space to have some degree of literacy or understanding around what is ESG, what is responsible investing, what is impact investing, and how does that outwork itself, becomes increasingly relevant. Even for myself, my own background, having spent half my career in banking and half my career in the developing world and working with NGOs, I think there's this moment or this opportunity where a recognition that even to solve the world, to work towards the Sustainable Development Goals requires institutional capital. But you actually need practitioners who understand investment, but who also understand the complexities and nuances of development. And we see that particularly apparent in the impact investment space, where you have a strong need for, I often say it's like a dance floor. The pinstripe suit bankers have turned up on one side of the dance floor, the NGOs sit on the other side of that dance floor. They're learning how to try and dance together and understand that risk is multidimensional, but also opportunities for investment are also quite profound. And you have consumers who are increasingly asking for this. So it's a key area to get right. And I think there's a lot of work that is being done. But again, I think that anyone moving into this space, having a degree of understanding and literacy in this area, even pure investors, need to understand non-financial risk, because it is increasingly conflated with the long-term financial performance and risk of any investment that practitioners are making.
Ross, so as I understand it, RIA certifies fund management companies, but do you provide any certification of individuals?
No, it's actually products. So RIA certifies actual products. And there's quite a rigorous process of regular review in those. And so a company or a fund manager will come to RIA and say, we would like to have product X or Y certified as a responsible investment. Again, a very rigorous process that comes with that. RIA itself has open membership, has over 500 members, asset owners, managers, advisors across Australia and New Zealand. But it's the product level that goes through the certification process.
Would there be a benefit in expanding what you do to include, having a rigorous process for certifying that, that someone is sufficiently educated and experienced to call themselves, a responsible investor? Concerned about, it's very easy to call yourself an expert. And what about professional standards when it comes to individuals who, are working in this space and have a huge amount of responsibility for, managing our money as, members of superannuation funds?
Yeah, look, I think it's a good call out, and I think professional development standards in this space, I would say it's a very, very buoyant market for anyone who does have capabilities in these areas. Again, because there's not a super fund or an asset manager in the country who isn't in some way, shape or form trying to grapple with this. So I know there's a number of business schools that run programs in this area, probably not dedicated programs at this point, but I think it is going to become an increasingly important area of this core competency, both for practitioners but also leaders in this area.
And I should point out that I teach in the Master of Applied Finance that Guy is the course director of, and of course we have ESG coverage in our curriculum, including courses on sustainable finance and whatnot. So sorry, I couldn't resist the plug there.
Just at one point, I think in our study, I think firms solve this problem two ways. One is by retraining staff, and two is by bringing in new staff with specific skills in these areas.
Yeah, I think too, there's a recognition that some of the traditional models and approaches for the science of investment change. And again, as the tide rises, as good practice starts to emerge and there are deep learnings that emerge, there's obviously a huge amount of research that is ongoing on, does ESG actually contribute to or detract from financial performance? What is very clear, though, and again, well supported by research, is that companies that have a good, let me call it a score well from an ESG standpoint, whether that's from diversity, equity, inclusion, or ethical sourcing, or smaller environmental footprints, governance, transparency, or just healthy workplaces, invariably when there are market shocks, that the recovery profile of those companies is stronger. So again, notwithstanding the ethics or morality of saying we want to exclude these particular sectors and focus investments in these areas, the investment thesis stacks up very strongly in favour of that. The other comment I'll make just very briefly, and the research obviously talked about your future, your super, and the benchmark performance testing regime that has been put in place, somewhat controversially. I don't think anyone would contest the value of trying to improve the comparability of how do you measure funds and how they perform against each other. The risk, of course, with a benchmark approach, as was highlighted with the research, is that it can act as a bit of a headwind for investment teams to want to take a longer term position or exclude certain sectors that then introduces an unacceptable level of what we call tracking error in a portfolio. But I would say even in a company such as Australian Ethical, where I work, where there is an absolute complete exclusion of fossil fuels, again, the investment thesis is rigorously tested, and there is a robust understanding and a conviction that the long-term financial interests of our members will benefit by adopting that exclusion, even if in certain market cycles it means you may be impacted or you'll perform differently to the market. So again, everyone is on a different point of that continuum. And to me, the key is that asset owners and asset managers seek to be true to label to the fullest extent possible. And again, the regulatory focus in this area is highlighting some of the potential gaps or areas where further work and focus is needed in that area.
Okay, so Marcella has got a very interesting question, which Ross alluded to and has come back as a question, which is, I'd like to understand how ASIC is getting involved or targeting greenwashing, please. Will there be any legislation around greenwashing?
It's a great question. Firstly, I would say that the regulatory focus in this area is not unexpected, and particularly if we follow other jurisdictions, Europe in particular, it's inevitable that regulators will take a heightened degree of focus in this area. How it will translate through to regulations or the expression of those things, I think, again, that will very naturally follow. But you also have some work being done, for example, the taxonomy I mentioned earlier, that is intended to provide a common set of standards around product labelling, etc. There's really, really good work and very strong momentum in those areas that has very strong engagement across, a large part of the fund management industry. So I think regulators are engaging thoughtfully and sensibly in that space. I think there is a little bit of shock and awe in some of the recent cases, even the one that we've seen get coverage this week, where from an ASIC standpoint, probably a couple of, public executions or very publicly profiled greenwashing cases certainly galvanizes the focus across the industry. Because as I mentioned earlier, consumers are voting with their feet, and there's an enormous inflow of capital to products in the marketplace that would profess to be ESG or responsible, etc. So it's really important you get the standards right. Otherwise, you end up with a somewhat meaningless set of language and terminology that frankly doesn't translate in any way to the underlying products. And so you want Australians to have confidence that if a company or a fund says we are ethical or we are ESG or we are responsibly invested, what does that actually mean? And what sectors are in that portfolio, what sectors aren't?
Fantastic. Okay, another question here, which actually picks up on one of the comments in the paper, which is to do with culture wars. Not all jurisdictions appear to be the same regarding the rise of ESG. What are the panelists' view on the anti-ESG sentiment that exists in markets such as the US? And I think we saw that in Texas, and sort of talking to some of the Blackstone's view on their stance on ESG. BlackRock, sorry.
Yeah. Vincent, do you want to have a go at that?
Sure. Well, I think in the case of the United States, everything gets politicized. And I think there is obviously a push for decarbonisation. There is companies out, companies who are potentially going to lose money, and they do fund, certain research that's probably possibly questionable on climate change and things like this. So there is obviously with these companies that possibly lose, potential to lose money in the future, they do put a lot of effort and money and expense into possibly decrediting ESG investing. So obviously America, like everything, I think America it's more politicized. That's why I think it's more controversial in America. Europe is different. Australia, so far, it's probably, I think, been closer to Europe than America.
I just add briefly that I think that this whole conflation between ESG and so-called woke capitalism, obviously, as Vincent said, becomes highly politicized in America. I think this is a bit like a swinging pendulum, frankly, and the challenge is that ESG as a concept ends up being tainted or compromised as a kind of a politically motivated agenda, as opposed to something that is fundamentally good for investors and the approach that it takes. The US will be the US, and I think that culture war will continue to play itself out. But to me, I think what will ultimately carry the day is the investment performance or the investment thesis. And again, to try to step back from the political rhetoric of motivation here, it's ultimately investors and investment teams who will look at which sectors they want to have deep exposure in, which sectors they want to reduce or be completely out of. And I think that's the benefit of an ESG lens on these things. But the practice is changing and evolving, and the tide is rising all the time. There's been good progress, but there's a significant level of work still to be done to kind of further strengthen all aspects of investors and their approach in this area.
Yeah. And I just feel we're very fortunate in Australia that because the way our superannuation system has evolved, and there's now such a large pot of money that is focused on preparing, long-term performance. Okay, so a very long-term investment horizon. It's helping retirees to have a decent future. I think, is that the correct terminology these days? Decent, at least. And because we've got so much money with this long-term focus, I think it does mean that investors have to really take climate change seriously. You can't afford to forget about it when the whole world is decarbonising, and you can't just focus on the short term. You have to be thinking about what's going to be happening 5, 10, 15, 20 years down the track. And to me, that's a lot of the reason why we have such an ESG-focused industry. It's because all of those issues become value relevant in the long term.
Right, we've got another question here. Actually, two questions, which are sort of, I think we'll cover two questions to this one question here. So it's a bit of a long one, so let me read it out. Arguably, two of the challenges in the sector are that data can be poor / non-existent or constantly under change, and that the ESG factors of focus do change over time. How often do you think that the data and benchmarks / targets / models for what ESG factors should be looked at should be reassessed? How can investors get their head around the cost and loss of continuity of assessing performance if the data and ESG factors being used for positive / negative filters is being changed too regularly? Who'd like to have a go at that?
I mean, I would hope that a lot of these changes are research-based, are evidence-based. Okay, so as new research comes to light, that the processes and the standards will be continually evolving. It should never. I don't think we can ever just say we've arrived at the answer. And I hope that the ESG investing industry will support research that's been done both in universities and in other places to try to continuously improve the way ESG performance is being measured.
Ross, any comments?
There's very significant investment work being done in this exact area to try to avoid the situation of, we go very deep on an E focus but ignore the S, etc. So I think, again, the narrative for me is the tide is rising everywhere, and even again, the combination of a regulatory focus, an investment focus, and a consumer-led movement of interest, it creates positive pressure in this space. So I think that's the headline there. There's further work still to be done in an important growth area.
So we've got time for one more question here, which I'll pick up, it's just a very simple question of, could you say a bit more about the culture and governance?
Yes. So I'm a risk governance expert. I've written a book on the topic. So I've spent years of my life researching governance and culture. I think when it comes, I think good risk governance picks up all types of risks, whether it be the risks associated with climate change, the risks associated with, any number of social issues. So culture, of course, is a crucial aspect of good governance. And I think one of the, there's a lot of confusion about how culture can be measured. It concerns me that there is still a lot of focus on companies' engagement scores. Okay, so we even see that in many cases, chief executives' performance is partly assessed through the staff engagement scores, and that's incredibly poor measure of culture. And we can do a whole lot better. So it does concern me that investors seem not to be very aware of a lot of the recent research in this area. What is best practice in terms of assessing the culture, especially from the outside. I briefly mentioned the idea of Glassdoor and other employee review sites. It's a little bit like TripAdvisor, but where employees can post anonymously about their employers, about the companies that they work for. And this is emerging as a very useful and validated form of culture information. So I was disappointed that more asset owners and asset managers are not picking up on that and making use of such techniques. It's probably not time for me to say any more, but I'd be happy if people would like to connect with me on LinkedIn. I can easily provide you with more information about that.
Thank you very much indeed, Elizabeth. So we're pretty much out of time. So it gives me the great pleasure to thank our speakers, Elizabeth and Vincent, and thank you very much to Ross. And I think just to mention that we will make the recording available and the actual paper that from Elizabeth and Vincent will also be available. So with that, let me thank you, everybody, for your attending. This is a really fascinating topic, and it's probably one that we'll be continuing to talk about. And so with that, good evening, and thank you again.
Thank you.